Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's edition, we're actually going to be talking about the importance of journaling your trades. Okay, so if you've been trading for any considerable length of time, I'm pretty sure you must have heard professional traders telling you that one of the things you'd need to do in order to become a consistently profitable trader is to actually journal your trades. And this might come in as a surprise to a lot of traders because I could say that, out of all of the profitable traders that I've come across, I would say about 90%, in fact, maybe a little more than that, a little more than 90% of the traders who are profitable who I've come across actually journal their trades. And compare this to the struggling traders or the beginners or the struggling intermediate traders who are still struggling to become profitable traders, or who are just going through that boom and bust cycle. They're just break even traders. Most of them just wing it. Not only do they not have a trading journal, but they also don't have a trading plan. Okay, and these are all things that you would find that most of the professional traders who do this for a living actually take they give most of more importance to than even the trading strategy they are using or anything else. Okay, so in this video, we're actually going to be talking about why you should journal your trades, and we're going to be starting with talking about why journaling matters. Okay, so you must have heard traders telling you that, okay, in order to become a profitable trader, you need to create a trading plan, you need to journal your trades, you need to review those trades, you need to do things like backtest, all of those things. Okay, but why is journaling important? Why does it matter? The first reason why journaling matters is because it helps you to see patterns in your behavior or your strategy. So what does this mean? So let me give you an example. Okay, so let's assume that you follow the advice of the professional traders and you're actually trading with a trading strategy that you've proven to work. So let's say you found a trading strategy or you created one from scratch and you back tested it, you for tested it, you tested it in the live markets, you've done all the whole testing thing and you've proven to yourself that that trading strategy is actually a profitable trading strategy. Okay, now the thing is, when you deploy that trading strategy into the live markets, when you deploy it on an account which you're hoping to trade and make enough profits to make a living off of, the thing that would matter the most, the thing that would determine whether you fail or you don't, is if you stick to your trading strategy or you stick to your trading plan. Because the problem is, there are lots of times that you'd find traders have a trading strategy that is actually profitable. They've done the testing and the numbers prove that the trading strategy is actually profitable. Even though past performance don't guarantee future results, when you have a trading strategy that worked in the past, there's a high likelihood that if the market conditions which favor it repeat themselves in the market, which often happens, that trading strategy is actually going to be profitable, right? Now, the problem is, most traders, when they go to deploy that trading strategy on the accounts that they're going to be using to trade the live markets, most of the times, especially inexperienced traders, when they encounter a couple of losing trades in a row, or a drawdown or losing streak or whatever, instead of firming it and then sticking to this, the trading strategy and their trading plan, they often deviate from that trading strategy. So, to give you an example, if, for example, you are trading with a trading strategy that is based on break and retest, okay? So, what the rules of the trading strategy is, you wait for a trend to occur in the market, and once you've found that trend, price is making maybe higher highs and higher lows and lower highs, for example, then you're going to actually wait for price to break that resistance if it's in a uptrending market, and then wait for it to pull back. And then when it pulls back to that resistance that it broke and it starts forming price rejection candlesticks, and then maybe you see something like a bullish engulfing, you're going to most likely, based on the trading strategy, you're going to take a trade in the direction of that trend. Okay? Now, let's assume that you've done your back test and you've proven that that trading strategy, aiming for maybe a 1:2 or 1:3, or whatever the case, risk to reward ratio, you've proven that that trading strategy is actually profitable. And it could still be profitable even if you lost more trades than you win. Because in this case, the risk to reward ratio that you're using, that the trading strategy is actually giving, let's say 1:3, for example. Even if you were to lose 60 out of 100 trades, those 40 trades that you will win will give you enough profits to cover for your losses and give you extra profits in the process. But the problem comes when one or two, losing trades, or let's say, to make it more realistic, let's say you encounter like 3 or 4 or 5 losing trades in a row. Most of the times, inexperienced traders look at this as, okay, my trading strategy is no longer working. And so when they find a signal, the next signal telling them to take a buy trade or a short trade based on what they've backtested, instead of maybe taking the trade, they might get analysis paralysis and refuse to take the trade because they'll be like, the last 5 trades were all losing trades. And so what makes this one any different? This could be also a losing trade. And it could so be that trade that you don't take might be the one which will give you a winning trade to recover most, or if not all, of the drawdown you're in. Okay? And so when you start cherry picking, okay, because I had a couple of losing trades, now I'm not going to take this trading trade because I'm not going to follow the strategy. Or maybe instead of risking 1% per trade, you decide, you know what, I lost 5 trades in a row and I want to make back everything I lost. So instead of risking 1% to make 3% based on what I've backtested and proven that it works, I'm going to risk 3%. Because I just want to make a 1:2 risk to reward ratio trade and make back everything that I've lost on those losing trades. And maybe that trade that you risk all of that amount on is also going to be another losing trade, which will drag you deeper into drawdown. Okay? So most of the times, keeping a trading journal helps you to see these problems. Are you trading with a trading strategy that has an edge? The logical answer is yes, if you've backtested it and you've proven that it works. And if you've backtested and proven that it works and you've traded it live, or maybe a small demo, a small live account, or whatever the case might be, and you've proven that it works, then the only thing you would need to do is to make sure that you stick to the rules of that trading strategy when you're trading it live on your big account. Okay? But then, if you don't keep a trading journal, then there's no way for you to know that, okay, I'm following this strategy to the T. So that when you're losing money on your account, it's going to be clear that, okay, it's the strategy that is experiencing a drawdown. It's not my fault. It's not emotions or anything. Or the strategy is doing exactly what it's supposed to do, but because I got emotional, during a winning streak or a losing streak or whatever the case might be, this is why my results are not as I expected based on what I've tested this trading strategy to deliver. Okay, I hope you get the point. If you don't keep a journal, it's going to be almost impossible for you to track this thing that we're talking about. So let me give you a quick rundown on how you're going to do this. Okay, when you're keeping a journal, whether you're using an Excel spreadsheet or whether you're using a online tool like my FX book, you want to use the tagging feature to actually tag the trades that you take. And those trades, I want you to break them down into 4 categories. Okay? The first category is going to be called good trades. Okay? These are going to be, let's type them out here. These are going to be called good trades. Okay? Your good trades are going to be the trades that, sorry, it's not even supposed to be good trades, it's supposed to be good wins, okay? So your good wins are trades that you take based on your trading strategies rules. So you're actually following your trading strategies rules, and those trades, it so happens that, it just favored you. Those trades turned out to be winning trades, okay? So those are going to be tagged as good wins. Then the next group of trades that you want to tag are going to be called good losses. Okay, so your good losses are going to be trades that you take which end up being losing trades, but because they are losing trade doesn't mean that they are bad trades, because any trading strategy that you use, most of the times, if you don't have a crystal ball and you don't see what's going to happen in the future, you're inevitably going to have winning trades and losing trades sprinkled in between. Okay, and so when you follow the rules of your trading strategy, so using the example that we gave, if you're using the break and retest trading strategy, you wait for price to break, and then when it retests and you take the trade when you see weakness around the area where it broke previously, and we're obviously in a trend, then when you take a trade based on your trading strategies rules and you do the proper risk management, do everything else that you're supposed to do according to your trading strategies rules, but you still end up losing that trade, that's actually a good loss. Because you followed your trading plan. And so that trade qualifies as a good losing trade. But what about the next category of trades that you want to tag? The next category are called bad wins. So what is a bad winning trade? Okay, a bad winning trade is a trade that you take going against your trading strategy's rules. Okay, so if your trading strategy tells you to wait for a break and retest before you take a trade in the direction of the trend, in this particular example, maybe you might wait for your for price to actually break, but instead of waiting for it to retest, you start second guessing and saying, you know what, it looks like this trend is very strong, and so it's going to be very difficult for price to retrace its step and come back to the place where it broke. So I'm going to take the trade here. And so you don't wait for a retracement and you take the trade. If that trade ends up being a winning trade, even though it's a winning trade, it's actually a bad trade because you broke the rules of your trading strategy. You broke the rules of your trading plan when you took that trade. And if you continue doing this, you're actually going to deviate from your trading plan, and it would eventually cost you lots of money or lots of effort that you would have done, because this is assuming that you've backtested the trading strategy that you want to trade with. You've proven that it works and you've done all of the work. But if you start straying from it and taking trades that are outside the rules of that trading strategy, then what are you doing? You should have not even backtested it in the first place. Okay, so if you continue taking bad wins, eventually it's going to lead to the fourth category, which are bad losses. Okay, and bad losses are usually the kind of losses that would end up blowing your trading account. These are losses that you take when you take a trading position that it's kind of like adding insult to injury, because in the first place, a bad loss is a trade that you take going against the rules of your trading strategy. Okay, and you take that trade going against the rules of your trading strategy only for it to also end up being a losing trade. So if you didn't even take it in the first place, it would have been good because your trading strategy told you not to take it, but you took it against your trading strategy's rules, against your trading plan, and it still ended up being a losing trade. So you don't want to. This is the worst of the worst. Okay, so what does this have to do with anything? When you tag your trades using this method, okay, after taking like a large number of trades, okay, like 100 trades, for example, okay, this would make it easy for you to see how many trades you took following your trading strategy's rules. So, for example, let's say you took 100 trades, okay, 100 trades. And out of those 100 trades that you took, 75% of the, or that 75 is a bit too much. So let's say 56 of them were good wins. Okay? And let's say 40, or 40 is a bit too much. Let's say 35 of them were, let's say 40. Let's say 40. Let's say 40 of them were good losses, meaning they were losing trades that you took, but you followed the rules of your trading strategy. You don't have done anything better, okay? So you follow the rules, and this is, you can't just escape this type of trades, okay? So 56 plus 40, this is 96 trades. So you had 2 bad wins and 2 bad losses. Now, in this case, you actually want to measure your discipline score. So the way to do that is to say, okay, out of these trades, 100 trades that I took, okay, 56 plus 40 is going to give me 96. And so 96, because we are calculating your good wins and your good losses, we are adding them and then getting the percentage of the trades that they are out of those 100 trades, okay? So 56 plus 40 is 96. 96 divided by 100 trades that you took is going to be 0.96, and 0.96 times 100 is going to be 96%. So this is assuming that your grade out of 100 is 96%. So this is actually not bad, because if you are grading your score, this would give you something like an A+. So yes, you followed the rules of your trading strategy, you did very well, but you also want to, as much as possible, make sure that in the next sample size of trades that you're taking, your bad wins and your bad losses should be 0. You want your grade to be close. The closer it gets to 100%, the better. Because here's the example. Let's assume that you're using you're taking your trading strategy straight as you're supposed to, risking 1% of your account capital per trade, and then aiming for a risk to reward ratio of maybe 1:2. With this 100 trades that you took, if you're risking 1% and aiming for a 1:2 risk to reward ratio, then with these 56 winning trades that you had, you would have made a lot of profit. Let's just do the numbers, okay? Risking 1% to make 2%. You would have made 2% from each winning trade. 56 times 2 is going to be, I think, 120 something. Let me quickly do the numbers here. Let me quickly type out the numbers. 56 times 2 is 112. Okay, so out of those 112, that's your gross profit. Now, when you subtract your gross loss from your gross profit, which will be minus 40% because you had 40 losing trades, okay, the good losses, you would have ended up with a net profit of 72% if we're not factoring in your bad wins and your bad losses. But here's where the problem arises. Okay, if those two bad losses that you took, and it so happened that the reason why they were categorized as bad losses was because you made a trading error which was risk management related. So on those two losing trades those two bad losses that you took, instead of following the rules of your trading strategy and risking 1% of your account capital on each trade you took, you actually broke that rule and risked something like 40% of your trading account capital on each one of those trades, and they all turned out to be losing trades. In this case, those two losing trades, those two bad losses alone, would have made you incur a loss of minus 80%. So even though you've done very well, you have a grade of like 96%, A plus or whatever, those two bad losing trades would have cost you to lose the 72% net profit that you would have gathered from those trades that you took just because of those two bad losses. Okay, so even though your grade is an A plus or whatever it would look like on the surface here, you still want to be careful with your bad wins and your bad losses. In an ideal situation, you want to position yourself in such a way that your bad wins and your bad losses are zero for whatever sample size of trades you take. Meaning you're taking exactly what your trading strategy rules and your trading plan tells you to without deviation. And that's where you want to be. That's where the professionals are, okay? So the reason why you want to actually journal is because if you don't journal, you cannot see where you're deviating from your trading plan. In a nutshell, that's just what this is, okay? So now that you know the reason why you want to journal your trades, okay? How do you go about doing it? I've explained this to you. Okay, so you're actually going to, record what do you record in your trading journal? That's essentially what I'm trying to say here. You want to record which trading currency pair did you trade, what direction is the trade that you took. So is it a long trade, meaning you bought, or is it a short trade, meaning you sold? What's your entry price? What's your exit price? What's the reason for taking the trade setup? Are you following your trading strategy? Okay, if you're trading with a discretionary trading strategy, is there context to the trade that you took? Okay, so, are you trading around pivot points or round numbers or whatever the case might be? Okay, these are the type of informations that you want to have in your trading journal. What was your stop loss level? What was your entry level? What's your take profit level? What were your emotions during, after, and before you even took the trade? All of those things. At the end of the day, when you close the trade, you also want to record what the result of the trade was. Was it a winning trade? Remember, we talked about tagging your trades also. So if it was a winning trade, was it a good win or a bad win? And if it was a losing trade, was it a good loss or a bad loss? And what was the risk to reward ratio of the trades? You want to take screenshots, because these will help you to revisit the trades that you took and see how well you're following your trading strategies plan, this trading strategy that you backtested, how you're doing all of those things, okay? These are the details that you want to have in your trading journal, okay? So it's very important to do this, because if you don't take the time to do this, then number one, not only are you not trading like a professional, but it's going to make your trading random. Because not only are you just going to be, taking trades without measuring anything, and if anything that you don't track, you can't improve it. Okay, so it's going to take out the randomness out of your trading and make sure that you are sticking to the plan and doing what you need to do to protect yourself from trading like, a reckless gambler. Okay. So again, keeping a trading journal is what the professionals do. If you want to become a professional who is going to be able to earn a living from their trading profits, you need to do what the professionals are doing, which is keeping a trading journal. Okay? And if you don't do this, I can tell you without a second thought that you're going to find it very, very difficult to transition from being a losing trader to a consistently profitable Forex trader. Because if you don't see the patterns or what you're doing wrong with your trading, then it's going to be almost impossible to improve. Because if you're keeping a trading journal, if your issue is discipline, that journal is going to show you in HD that your problem is that you're not following the rules of your trading strategy. So maybe your trading strategy says to risk 1%, and you're keeping a trading journal. And so every time that you take a trade where you risk more than 1% or less than 1%, your trading journal is going to show that to you. So if you take like 100 trades, and it so happens that your bad wins or your bad losses are like 50% of the trades that you took, and all of those trades were because of you either risking too much or too little, then there's your answer. One of the reasons why you're not profitable is probably because of your risk management and you not sticking to the rules of your risk management rules of your trading strategy or your trading plan. And if that's not the case, let's say your risk management is on point. You're never risking more than 1% and you're always having a good risk to reward ratio. But the problem is you don't let your trades hit their profit target. So if you're taking a trade where you're risking 1%, okay, your stop loss is placed somewhere here and you're aiming for a 1:4 risk to reward ratio, for example. But then every time you take the trade and price just moves slightly in your favor and then it doesn't, goes directly to your profit target in just one move, and it starts to retrace a little bit, which is normal in the trending market, but you start getting scared and you immediately just close your trades. So you never leave your trades to hit their full profit potential. And so every time your trade just reaches maybe 1 hour or 2 hour and it starts retracing, you close the trade without letting it hit your profit target. Your journal is going to record that. And maybe if you're not profitable because the profits from your trades, winning trades, are not enough to cover for the losses from your losing trades, that's where you're going to see it in your journal. You're going to see that the problem that is causing this, the issue that is causing this problem for you is the profits from your winning trades are too small to cover for the losses from your losing trades. And the reason why that's the case is because you do not allow your trades to hit their profit target. If you don't keep a trading journal, how can you see all of these informations? It's going to be almost impossible for you to see it. Okay? Or maybe price just comes very close to hitting your stop loss. And instead of letting price play the way your trading strategy showed you in the backtest. So if price comes near your stop loss, instead of doing what you're supposed to do and leaving that trade, set and forget, you don't touch it. You start seeing price coming close to your stop loss and you get fearful. And then you just close the trade before price hits your stop loss, only for price to reverse from just a couple of pips away from your stop loss to go all the way up to hit your profit target. If you keep doing this, if you don't keep a trading journal, you can't see that you're making this error over and over and over again. And it's right there in plain sight. These are the reasons why you need to keep a journal. If you don't keep a journal and you don't record things like this, you're not going to know that you're actually making these mistakes over and over and over again. And they are the things that are costing you becoming a consistently profitable trader. They are the things that are serving as a barrier, preventing you from becoming a consistently profitable trader. Okay, so you need to keep a journal for these reasons. You need to keep a journal to be able to detect where these errors are so that you can work on them. If your problem is you're not letting your trades to hit their full stop loss after accepting the loss and doing proper risk management, then start leaving your trades to hit their stop loss because you've backtested this trading strategy. And I'm pretty sure that during your backtest, there are times when you have trades that will come very close to hitting your stop loss, only for them to reverse from, without hitting your stop loss and going all the way to hit your profit target. When you see this happening in the live market, remember the time you saw this in the backtest. Leave them. Before you place the trade, you actually did the proper position size calculation, and you must have accepted that 1% of my account capital, I'm willing. In fact, let me give you a cool little trick here. Okay? What most professional traders do most of the times is before they take a trade, they learn to accept the loss that is associated with that trade. So what does this mean? This means that when they're about to take a trade and they've come to terms with the fact that they are risking 1% of their trading account capital on that trading position, they are actually not going to consider that trade as, a winning trade or anything. They're just going to have it at the back of their mind as if that trade is already a losing trade. So it's like the 1% that they're risking on that particular trade has already been taken out of their trading account. And so when they do it like this, if price now starts inching towards hitting their stop loss, they've already come to terms with the fact that price is, they've lost the trade. And so it doesn't really bother them all that much. So even if the trade hits their stop loss, they're not bothered because, they already accepted that the trade could turn out to be a losing trade. But this is the opposite of what most beginners do. Because most beginners, most of the times, is they're going to take a trade and then they're going to be like, okay, I would be risking 2% or 5% or whatever the case might be on this particular trade that I'm taking. But then after they enter the trade and price starts coming towards their stop loss, they get so scared that they close the trade without letting it play out. Because in the first place, they never really accepted that the risk on that trade they were taking was how it was placed, okay? So moving forward, this is the reasons why you need to journal your trade. Okay, and to do a quick recap, I explained to you not only the reasons why you need to journal your trade and how to journal your trade, but I also told you why journaling will help you to become a consistently profitable trader. It will show you in HD the mistakes that you are making that are preventing you from becoming a consistently profitable trader. And it will also show you so that you can know what to do about it. Okay, so take this very seriously. Okay, first things first, if you don't have a profitable trading strategy, find one or create one from scratch and then back test it test it live in the markets on a small account, or if you don't want to do that with real money, do it on a demo account. But on a small account, which is a real account, it's much more going to reflect to you more often than not what the live market conditions are likely going to be with the broker that you choose. Okay, so do that. And then once you've done all of this, keep a journal of the trades that you are taking so that you can see how well you are following the trading plan that you created, how well you're following the rules of your trading strategy. Okay, and so that's going to help you to see what's preventing you from becoming profitable. If at the end of the day you take a number of trades, so finally, before we wrap up this week's edition of the class, I would like to use this opportunity to actually invite you guys to take advantage of the tools that we offer, the bots that we offer, which are designed to place trades for you. Look for low risk, high probability trading positions and place those trades for you while you're actually out there doing what it is you want to do with your time. So they will trade automatically for you with proper risk management, following our recommendations, and they will help you to start earning while you're learning, okay? So this segment, this portion of the ITU Global is designed to teach you how to trade with manual trading techniques, which are aimed at helping you become a consistently profitable trader using manual techniques, okay? But the bots are designed to help you to achieve that, to achieve profitability using automated means. Okay, so if you're interested, please reach out to us on the socials and let us know, and we'll be more than happy to assist you set everything up, or just drop a comment on this particular video's comment section. Okay, so if you're interested, please let us know, and I look forward to seeing you guys in next week's edition of the class. Once again, thank you and God bless you all. Enjoy the rest of your trading week. Go out there and crush the markets. Okay, God bless you.